So, Gary, thank you for joining our second podcast with BitX Capital. And I really appreciate you coming today. And for the viewers and listeners, you can reach Gary Gulemi. He's here in Fairfield, Connecticut. His cell phone or his phone number is 203-254-9960. And Gary, you specialize in life insurance, health insurance, and long-term care. And then today, for our interview, we're going to talk about being a small business owner and the benefits of life insurance, both from a growth standpoint, a protection standpoint, and accessing the asset conversation and preserving your wealth. And so, again, Gary, thank you for coming. So, Gary, the purpose of our podcast today is, again, we have small business owners and they're always looking for how do I create wealth and how do I protect wealth? And I thought you would be the perfect person for that conversation. So, Gary, how did you get into the business of life insurance? And, tell me more.
Well, 25 years ago, I was in manufacturing, still am, and there was a demise of the manufacturing sector in New England. And I saw the writing on the wall, and the markets were going to dry up. Manufacturing was going offshore. And I said, gee, what would I like to do is to add to this? I had young kids, and I couldn't pack it in then. So I studied and got myself, licensed, and I started doing it. And I really, really liked life insurance. I was doing securities and all. And then I decided I'll pick one thing that I really like that I can make a career out of. And instead of being a little bit of everything, I was a lot of one thing, and that was fixed life insurance. And that's a solution to many, many, many problems. So I'm glad I did it. It's been 22 years now, and here I am.
Well, we've known each other for over 10 years in our networking group Sphere. And I hear you telling countless stories of helping both business owners and individuals with their life insurance. And one of the critical phase, or I guess where you start, is the wealth growth phase. Like, how do you start building wealth? And I know, you can do it through different types of assets, such as real estate, gold, paintings, etc. But people don't always think of life insurance. And so Can you tell me a little bit about the wealth growth phase?
Yeah. What's typically available to everybody are the IRAs, 401ks, if they're in corporations and all that. And that's great. Use those tools. Life insurance is another tool that can be used. It enjoys many of those features of tax-deferred growth, and there's some rules with life insurance that enable it to be very efficient and effective manner. There's different types of insurance, and there's different models for that. But life insurance can be utilized to grow an asset, cash asset, for use decades later.
Tell me a little bit more about term versus perm.
Okay, yeah. Life insurance comes in two basic forms. Term insurance, which is essentially less expensive. You don't build anything. You don't build any equity. You don't build any cash. It's like renting an apartment. You rent it, you pay. When the term ends, when you move out, you have nothing. However, when you buy a house, that's more like a permanent insurance policy. Now, you're paying more money and you're in it for a longer period of time, but you're building equity. So when you buy the house, it's like buying a permanent insurance policy. You end up with something of value as time goes on.
Nice. So can you tell me a little bit more about universal or perm, and then universal being a part of perm?
Yeah, universal life is a form of permanent insurance. Whole life is the products that have been out there for 100+ years. Universal life is more like the last 25, 30 years. It's more modern. It's more efficient. There's some things about it, some aspects to it that make it more usable for certain specific goals. So when I when I talk with people like a business owner, and the business owner wants to accomplish a certain goal, we find the right model, the right plan design to achieve that goal.
Can you tell me a story about one of your business owners you worked with recently
Mhm.
that where you modeled a certain way? Maybe they were a startup, maybe they were 30, with 35-year-old, or maybe they were 45 or 50 years old, and maybe they're coming out of, the kids are going empty nest and leaving, or maybe they were 65 years old they have a lot of wealth that they accumulated and they don't need a 401k or they don't need an IRA, but now they need life insurance. So maybe if you can tell me one of the stories.
Yeah, it was a company that had two young employees that were going to be on the ownership track. They will eventually own the company as the owners passed it along to them. And they decided these men were both in their mid 30s. So what they decided to do was provide a goal, and that goal was a retirement asset. And they used what's known as an accumulator model. An accumulator model is the premiums are paid over decades. The owner of the company is the owner of the insurance policy. And they're also the owner is the beneficiary of the insurance policy. The insured is the employee. So you say, what's in it for the employee? Well, the second phase is where after they retire, the company gives the policy to the insured when they're 65, 68, whatever they decide to do. And then that employee spouse to be the beneficiary, and then he starts taking the distributions of all of those assets that had grown over those years. Now, another feature of that is during that 30-year window of time, when the owner is the employer, these employees are valuable. They provide a valuable content to the company. If they were to die, they would be very difficult to replace. It would cost a lot of money in just bringing in the temporary and then to ultimately hire and train. So the death benefit that is in the policy during the course of time when the employee is working would function as a key person policy. So if that employee passed away, well, there's no longer a need or a goal for retirement assets, but the company would benefit from the benefit of the face value, which would be the death benefit. They would get that cash and use that cash to sustain their business.
And then on the employee side, they have a golden handcuff in a sense where if they are truly dedicated to this company and want to see it grow and thrive over 30 years, at the end, they have a nice nest egg waiting for them.
A very nice estate. Very nice.
Great, great. And so, in that vein, what about if I have a partner and, and what's the benefit of having a perm life insurance policy in place when you have partnerships or with multiple partners or multiple owners?
Yeah, so that example was where a company provided this for an employee, but many cases where the employer, the owner, the company does it for himself. Okay, it's a tool for any individual, whether they're in a big company or just they're self-employed or whatever they are. So the what could derail the growth phase is if you died. That's one way. So you get term insurance to sort of cover that, to protect that asset, which is your earning ability. On the other side of the coin, if you have a partner, say two people have a partner in a business, and one brings one set of skills to the table and the other brings the other, and the two of them are perfect together. It's peanut butter and jelly. They're just made to work together. If one of them was to pass away, then what happens? Well, now my partner is the estate or the spouse of that person that was so valuable, but that estate of that spouse is not going to be coming to work every day and providing anything. But yet, I now have a partner that's non-performing. So a common tool is a buy-sell agreement where partners, two of them, three, six, whatever the number is, they have an insurance policy, usually a term insurance policy that is used under the structure of a document that's created by an attorney. That has to be the case. It has to be consultation with attorneys, in which the agreement is that if one partner was to pass away, the estate agrees to switch where the remaining owner ends up as the sole owner, and the spouse or the estate is paid out. So they're bought they buy the shares from them, and they both go their separate ways. And now the owner has a company that he owns.
So I'm hearing in this asset is both growth and protection. That's what I'm hearing.
Yeah.
Yeah.
It's protecting the company from something that could derail the game plan. The game plan being the retirement asset. That's what the goal is. And what could derail it? A bad situation where you now can't make enough money because you have a non-performing partner, or a key person policy, which I mentioned earlier, where you're not giving them this big long-term deal. You just have, I need you, you're my chef, or you're my top IT guy, or whatever you happen to be. And if you were to die, I have a problem. I now have to replace your skill. So it's a common thing, a key person policy, and that gives the company some cash so they can sustain, so that owner can continue to build his wealth or her wealth.
Nice. So let's talk a little bit about accessing the wealth. And a lot of small business owners, hear life insurance or, universal life, and they hear that they can build what's called a bank of money. And life insurance provides that vehicle to do it. Not only are you protecting, you're growing, but you have this asset that you actually can tap into if needed. So can you talk about the accessing the wealth portion?
Well, the second component to achieving the goal, the first portion of that is growing it. Now that you got it, okay, getting it out in an efficient, friendly way is the key. It's not how much you make, it's how much you end up getting. So life insurance has some very strong benefits. All that cash grows inside this policy in a very efficient way. And then when it's ready to be distributed in these universal life policies, now a person that has been diligently building this, now they're 68 years old, they want to turn on the distribution in the form of X amount of dollars per month for the next 20 years, 25 years. So how do they do that? Well, with these more modern policies, they can withdraw the basis. So if they were to put in $300,000, $400,000, $500,000 over all those years, that comes out first without any taxes or loans. See, any of these permanent policies, if you can always take money out, but if you just withdraw the money, it's taxed as income.
So withdrawing early.
Withdrawing at any time, the gains are taxed.
So talk about that. So what is a distribution versus a withdrawal? What's the definition?
A withdrawal is when you go to an ATM and say, give me money. Right. So that's taxed. When you take money out of those policies in the form of a loan, there's no tax. So a lot of older policies have very onerous loan interest rates, which is not the way to go. These accumulator models have strong growth phases, and then on the distribution phase, two things. One, you withdraw the basis, so you get out all that original money without any implications of tax. And then when you start to go into the actual asset now that you have to borrow, they have loan interest rates that are very, very low. It's very efficiently effective to take the money out that way because there's no tax and you're not accumulating a big loan in there. Now, the goal of this is to take most of the money out. It's important that you never lapse the policy because that's a very serious problem. If you did before you die, then you have a lapsed policy, and that's very devastating because now you have a 1099 on all the gain. You have no cash value because you lapsed it, and there's no death benefit to boot. So you've got about 3 ways to feel sorry for that. So these policies are designed to not be overdrawn.
So, but let's talk about distribution now. Is it almost like a 401k where there's a planned, this is how much you're allowed to take on a calendar year, and if you follow these guidelines, you're not going to be taxed. That's a distribution, right? Whereas a withdrawal is if I do the ATM and I just say, hey, give me $100,000 and not consider it a loan, not consider it a distribution, just give me $100,000. That's the taxable.
That's taxable, and that's not wise.
That's not wise.
Yeah.
So if we follow the loan process, today's products have low interest rates, and then, or if we do the withdrawal. So what if I were to what if I'm a business owner and I have a restaurant
Yeah.
and I want to redo the whole kitchen and I want $100,000 and I'm willing to take it out in a loan? What do you advise? Do you advise going down that path or going to a lender like me and borrowing the money? So even though I get this really attractive interest rate over here.
Actually, you would get an attractive interest rate. However, you would derail your original goal because when you take money out, unless you put it back,
Mhm.
okay, and most people don't because it's not a bank. It's your cash value in your personal policy. There's no one saying you got to pay it back, and so people typically don't pay the loan back, nor do they pay the interest on it. So it's sort of you shoot yourself in the foot. What you originally set out to do is not really going to be accomplished in a very good manner because you derailed it. You took away the fuel, the growth, the internal growth. Now, I would then say there's other vehicles, like someone like yourself, you're designed to provide these types of loans for business owners in attractive manners.
Mhm.
So that's what I would suggest people do. Leave that alone. We're trying to protect it, and you have to protect it against yourself, not just against a partner dying or some other thing.
Yeah, well, let's talk about that. Let's talk about retirement. Let's talk about getting in these type of policies. There's long-term care.
Mm.
So you're trying to the goal, as you just mentioned, the goal is to build wealth through this vehicle and to be able to retire with a lot of cash so that way you can make all the decisions versus other people making decisions for you when you don't have the cash or you don't have the means. So talk about that, holding on to the original goal of having so much wealth that you can self-sustain until you pass away.
Yeah, you've done it all. You've done it right. You invested diligently. You protected it. You have now a big, beautiful asset. You're in retirement. You're drawing it down. And all of a sudden, you find yourself in a situation where you need long term care in a facility or you just at home. It usually starts at home. And one of the few things that can really take apart an estate is a prolonged long-term care, nursing home, memory care facility. For years and years, they cost a lot of money. And if you don't have long-term care insurance, now you have to come up with the asset. You have to fund it in some way. And usually you have to spend a lot of money to do that. So another tool with life insurance is another defined goal is I want long-term care benefits later in life. So when people who start when they're 45, 55, 60 years old have time to enable a long-term care benefit to grow, usually at a very nice, healthy compounding, tax deferred. Everything's tax deferred. And when the money comes out for long-term care benefits, it's tax free. So you're using a life insurance policy to provide an asset when you're 80, 85 that is used to pay those long-term care expenses, leaving your goal, the retirement money, intact.
Mhm.
So that's how that works. And by the way, if the beauty of using a life insurance policy in that realm is if you don't need the long-term care, if you just pass away, like many do, cancer, heart attack, whatever, you then have a death benefit. It's not like if you don't use it, you lose it. If you don't use it for long-term care, you still get the death benefit, which in most cases, the ones I try to provide is at least equal to the premiums that have been put in. So you're reimbursed.
Well, I'm gone, but my estate is reimbursed.
Right. My spouse.
Yeah, my spouse. So yeah, like us men, we typically have a shorter lifespan than mom, and mom lives longer.
Yeah.
And so that benefit goes a long way to the estate.
Yes, it does, because that way, if the male spouse goes into a facility, he doesn't have to sit there and rue the day that he didn't have any insurance because now he's wiping out his estate and he's leaving his poor spouse broke, where they have to even sell the house and all that. These types of tools prevent those types of problems.
Right. Yeah. So talk about that. Talk about estates that can be worth say $10 million with all the assets, and then you take out a nice life insurance policy to protect from, let's say, Uncle Sam, from taxes. So can you talk a little bit about that?
Oh, yeah. Yeah. Now, that's a different type of model. Now, that type of model, typically, you don't want to build cash because cash doesn't mean anything. It's an estate plan.
Mm-hmm.
The estate plan is I want cash upon my death that'll satisfy the taxes. And a very good manner of doing that is to buy a big old life insurance policy that's guaranteed to date of death, usually to age 105 or something like that. Mostly that works. And in which there's no cash growth. You don't need that.
Mm-hmm.
It's all about death benefit. So that's yet a different model entirely. So when I communicate with people and they say, well, I want to protect my estate at time of death. Well, we're not talking about accumulators and we're not talking about life insurance blended with long-term care. We're talking about a straight up pure death benefit.
And would that be term?
No, it wouldn't be term, it'd be permanent.
Okay.
Because it has to take them to the date of death. And term insurance generally runs 30 years.
Got it.
So, and they don't sell term insurance policies to people that are 70 that are supposed to go 30 years because that becomes a permanent.
We'll speak to that. So now we have 3 different types of policy. Permanent would allow me as a 70-year-old to buy insurance, even though I may have some ailments, and the insurance company will figure out what that premium is based upon the risk and take me all the way to death.
Right. Now, bear in mind, looking at it from the perspective of the life insurance carrier, the actual company, when they sell a term insurance policy, they realize that in almost all cases, they're not going to pay the death benefit. It's just peace of mind. It's less expensive. Mm-hmm. What they don't do is sell a term insurance policy where there's any real risk of someone passing away. So that's why they do the underwriting to see if there's heart disease or if there's some reason why that individual would pass away before the term would end. Now, a permanent policy, the carrier realizes we're paying this benefit. We have to charge appropriately because if it's a $500,000 benefit or $2 million, there'll come a day where that individual will die, and we're going to have to pay that. So they have to plan for that. And that's why one's called permanent, because the carrier is going to pay.
They know they're going to pay.
Right.
Gotcha.
And term insurance, they don't expect to pay.
Yeah, they're using how do I say it? Models of of what the odds are on a man or a woman passing away.
Exactly that.
Yeah. Yeah. All right. So again, our listeners are small business owners, 35 years old, or they can be 65 or 70. But to the 35-year-old young entrepreneur out there, what advice can you give them? Help summarize everything we just discussed. Okay. And if you were 35 years old, how would you set yourself up for success later in life?
Okay. When I was 35, what I was doing was the first thing you need to do is you have to protect your ability to earn income. Because if you have a family, children, that's a term insurance policy. It's inexpensive. You get a big term insurance policy for 20, 30 years, and then you set your goals for later on in life in the long-term phase. This is the near term. The long term, you protect it with this term insurance, even if it's just income protection, which is the most common utilization of term insurance. Then you start to think about my goals. What do I want? The first thing you do is you have to set up, it's like having an emergency fund, always a certain amount of money in the bank readily available in the event that you have an income loss, short term. So you don't have to upset all these investments. You just say, okay, here's my money market. I have to pull out this much money, but without upsetting everything else. So term insurance is the first thing you do. And once you do that, then you start to think about my permanent side. People don't think about long-term care until they're in their late 40s at the earliest, but they think about their retirement when they start to get serious, which is 35, 40, 45. And it's very beneficial to do it then because you've got 30 plus years to have it grow. And time is everything when it comes to these growth vehicles.
Okay. So I have my IRAs, I have my 401ks, I now have my universal perm insurance, and now I'm I could be 70 and I can set myself up for even more insurance to protect my assets from Uncle Sam and et cetera, et cetera.
That's the plan. And utilizing life insurance is a pretty attractive way to do these things.
Okay, sweet. So I want to thank you,
Thank you.
for coming today. This is great information. I'm sure the viewers and listeners will get a lot out of it. And I want to thank you. And again, Gary, let's just repeat it. How can they get a hold of you? And if they want to have a session with you, what's the best method?
Call me. Just call my office. 203-254-9960 is the office phone. Call.
And you work with people in California and Florida and Maine?
All over the country.
All over the country. That's great.
Clients everywhere.
That's awesome. Gary, thank you for coming today. That was awesome.
Thank you.
Appreciate it.
Thank you.
Yep. We just talked life insurance with Gary Gulemi at Sound Insurance Solutions, and we recovered both growth, protect, access, and preserve wealth. So if you need anything in insurance, I want you to call Gary Gulemi, as he's an expert, years of experience. And if you need anything in business funding or business loans, I want you to give me a call. So again, follow, like, and share. Visit our website for more information, and I'll see you on the next one.